Hello, everybody. I'm Michael Smith. Welcome to the Lowdown, and we're partying like it's 1999. Hello, everybody. Joining me today is Kevin Lenox, and joining me for the party. Welcome to the show, Kevin. Well, let's just get right to it. The elephant in the room, the attribution of this market, and it's been really, three major companies in the S&P, or we can call it one, NVIDIA. But let's talk about why are we talking about like this is 1999? How overvalued, how much run have these stocks had?
It's significant. I saw the top 10 stocks account for a little more than a third of the S&P 500 and have accounted for 74% of the total gain in the S&P 500.
That is insane.
So in that respect, it's like 1999, the top of the dot-com boom, where you had just a handful of stocks accounting for almost all of the return.
Well, what are some of the things you're hearing right now? Because, again, you always hear the thought, well, it's different this time, right? I mean, we hear, well, it's artificial intelligence. This is something we haven't seen. It's a new technology. But you and I were, we were in the business back in the 1999 when everybody was telling us the same thing. I remember people talking about, your allocations could be more aggressive. You can account for higher rates of return, and all of it was sustainable because of these things. And of course, you and I know exactly how that party ended. Right. It didn't end too well. What are your thoughts about some of the things you're hearing here?
So a lot of parallels. Mm-hmm. And I saw where equity ownership by households is at a record high now. And that's not surprising. And everybody seemed to be crowded into the same trade. Now, it's not the Magnificent Seven anymore, where Tesla dropped off.
Yeah.
So becoming a little bit more selective. But when Wall Street grabs hold of a theme and it starts performing, then a lot of times it goes on a lot longer than it should. We've had a thesis around large cap, high quality, self-funding businesses with dominant market share, can do buybacks. These stocks fit that criteria. But it looks like it's getting a bit extended here. And we're seeing for the first time, I'd say over the last maybe 6 weeks, other asset classes starting to give signals that the economy may be slowing down. It could be just a very temporary slowdown. It could be something more. But we've got treasury yields and oil prices sitting on key levels right now, and there just seems to be a shift in tone. And we talked about the consumer earlier pre-show. Signs of slowing there. The Citigroup Economic Surprise Index is back into negative territory, and we've got negative commentary about the consumer from like Lowe's, Floor & Decor, more and more companies starting to talk about weakness at the low to moderate income level. And it seems to be spreading, and then that's how things get started, and then there's a rebalancing in the economy.
So that's kind of the canary in the coal mine. So, kind of back to the valuations, and remember back then Sun Micro and Cisco, you saw one of the metrics back then, price of sales at 20. Just to give you an idea, NVIDIA's price of sales is at 50. I mean, it's substantially higher than we've seen any time in history. Another thing that concerns me is there is almost zero short interest. Nobody is short. Everybody's long. And you know what? When everybody's on one side of the equation, typically something gets rebalanced, something gets shook. Now, I'm not saying I'm not advocating for a crash, but I think you can see a shift in, in terms of rotation where the money flows. And ultimately, we're due for something here, right?
Yeah, things, we have something of a contrarian bent here at the firm. And it's important to focus on valuation, and your entry point into a position matters.
Yeah.
So we try to buy right, but then you also have to use discipline on the other side. When has something become a dominant part of my portfolio to where now my overall portfolio risk level is higher, because now I've got 10 companies that contribute a lot more to my overall portfolio than they used to. And what I see among other portfolios is, well, they've got 5, 6, 8 different U.S. domestic ETFs or mutual funds or managed money, and they own many of the same stocks.
Yeah.
So if there's an eventual, and we've seen it before, and we saw it certainly in 2000, when there's a correction in the momentum stocks, it can be violent, it can be very quick. And as one large player reallocates, the others will do so en masse. And then you don't have a problem with just one mutual fund or ETF or just the S&P 500. All of a sudden you found out that 4 out of 5 of your other U.S. equity mutual funds also had those same stocks in the top 10.
Well, the other thing is I remember back in 1999, I hadn't seen a correction, right? I mean, I went through the 90s, everything went up. I remember cheering, markets are hitting new highs every day. People were getting excited. And if you look at kind of this, younger generation, the meme stocks, right? I mean, the post-pandemic, we're back, we're seeing the AMCs of the world, all these companies that make no sense or why they're going higher. And the younger generation, they have not seen a correction. They don't know what that looks like. And so just, history has a tendency to repeat itself. So I think we're, very close there. But why don't you actually try to do this? I mean, we talked about the bullish and bear case last time. What do you make for the bullish case? And then we can kind of get into some of the things that contribute for maybe a bearish case.
So I think what's front and center right now, what we're looking at is the, like I said, the treasury yields, which have been trending down.
Mm-hmm.
And is that signifying, and we see some weakness like in leveraged loans and some other parts of the credit market that make you go, is this the start of something, or is this just a normal slowdown in growth that simply proves to be temporary? But we're also seeing signs of the consumer slowing down. So if that takes place, then that would obviously be a risk. So that's one of the things that we're looking at. Corporate earnings for Q2 are just about to come out.
Mm-hmm.
The expectation is 9% growth year over year, which is good, and profit margins that expand to 12%.
Yeah.
So that part still looks good, but I think we're going to see more bifurcation in the Q2 numbers versus Q1, in that those that have more exposure to low and moderate income consumers, I think those will start to struggle more and more.
Well, I think that, kind of maybe getting into a little bit more of the bearish case, as talked about, the economy is definitely starting to see some slowdown in the economy, but in particular to the consumer. Remember, consumer drives 70% of GDP, so that is a big factor. And if you look at right now with Target, Walmart's, I mean, everyone has been going after the low end of the consumer, which has been affected the most by inflation. But now the middle America is starting to really get hit. As a matter of fact, I mean, kind of the term that came out is middle America is spending now focusing on what they're earning, whereas if you've been looking at this whole time, well, if I have credit, I'm out spending what I think I can make down in the future. Now they're bringing it back home. So we're becoming more of an informed consumer. You're actually looking and searching to see where the best price options are. So I think you're seeing a more frugal consumer, and, it concerns me that's moving into the middle. And then also on top of that, CapEx spending, which is businesses' spending plans, have pretty much started to slow pretty considerably. And so you're looking out the next 6 months, businesses are basically halting on spending, and on top of that, hiring, which I know you want to get into as well.
Yeah, so we've now just over 2 years into this hiking cycle.
Mm-hmm.
And because of all the heavy fiscal spending that's gone on, it's really overshadowed the impact of rising rates. But for where we are now, borrowing rates for households, most households and corporations, is too high.
Yeah.
And every month that rates stay higher, you've got another household that has to take on debt at a meaningfully higher level, another small company that has to refi at a much higher rate. And that has a slowing impact on the economy. And in one of the slides, we have high yield companies and leveraged loan companies showing that the default cycle is starting. And that's where it starts. It starts with the weaker, more leveraged players on the household side and the corporation side. And I believe within the high yield index, they employ the companies involved employ about 11 million people, and on the leveraged loan side, about 8 million people. So if that trend continues higher, rates stay higher for longer, you could see a meaningful uptick in unemployment as these companies have to refi debt at a higher level, especially if you do have a bit of a slowdown in economic growth, which hurts the top end revenues.
So we're about to get the CPI numbers. The Fed is, going to be in this kind of this mid-year. I think September is kind of their big meeting. But, we're getting pretty close to, the levels of where the Fed has basically said they wanted to get to, the 2% target. Do you think they might try to get some readjustment to that target here coming into the meetings? And also one of the things I maybe get your comments on is, well, the Fed doesn't want to play politics, right? So we got the election coming up. Do you think that matters in terms of them trying to hold rates higher? Or if, we get to the point where, we're going to see a shift in the economy, do you think they'll jump in there and cut aggressively?
I think if there's a shift, they will cut.
Okay.
I really don't think they're going to make much of an impact on the election.
So basically politics don't matter, which is, I think you and I have tried to tell people that for the most part. It's a lot of noise, but it shouldn't really be the deciding factor for the Fed.
In regards to CPI, I know a lot of people watch that, the internal components, and we do as well. And I think there's a case to be made based on the way things are going that this slow disinflationary pace will continue more because the leading indicators, for example, rents and autos is slowing down.
Sure.
So there's a catch-up process, and we think that will show a continuation of this disinflationary process where prices are still going up, but they're going up at a slower rate. That's what disinflation means. What I'm keeping a close eye on, I mentioned before, oil is at a key level. Brent at 85. So that's moving back up toward the higher end of the range. If that continues to move higher, then we can see a direct impact that higher oil prices and commodity prices have on, for example, the 10-year Treasury. We have a chart, but also on CPI, and actually more on core CPI than many people think. So we're optimistic looking at just the components by themselves, that trend within CPI, but commodities are going to be the wild card in this, how this plays out. And if oil prices move higher, then it's going to make it very problematic for the Fed to cut rates.
So it sounds like, from what I'm hearing you say, and then what I'm just kind of hearing in general, is the Fed's going to try and hold out as long as they can, and it might be right to the final minute that they have to step in and do something, with all things considered. Now, the one factor that always gets me thinking is the borrowing cost. I mean, the cost of debt. We know that Republican or Democrat doesn't matter. They're spending beyond anything I think we thought we'd see. And the cost of that debt is surging higher. There's also a lot of potential losses on some of these banks' balance sheets as well. But maybe speak to that a little bit in regards to that being a factor.
Yeah, I'm very much in the camp of inflation staying sticky. That the deficit is now, just the budget deficit, almost 7% of GDP. So those fiscal tailwinds are going to keep growth elevated, which is good.
Yeah.
But it's also going to be a support for higher prices as well. Defense spending, as far as the eye can see, no cuts there. That's going to continue. This whole energy transition to support the build out of AI,
the grid and everything,
is inflationary. And then deglobalization on top of that. In a more multipolar type of world, we're not going to have the efficiency in supply chains anymore that we've had before. And then if tariffs move up higher, right now I think there's a 42% chance of a Republican clean sweep. If that happens, then there's talks of a 10% across the board lift in tariffs and 60% on Chinese imports.
Yeah, the re-onshoring story is going to take a long time to, kind of fit back and become the best price. I mean, that's going to be, we're going to see, I think, that's why I think inflation comes in waves. As we try to readjust, that's going to take quite some time. So
I don't think it's just the quick move back down to 2%.
No.
And everything is fine. It's a lot more nuanced.
Yeah, we won't get the post-pandemic surge, but we're going to have bouts of inflation until, we see it moderate in the future. Now, so with all this being said, here we are again, we're about halfway through the year, kind of looking at what you and I just talked about, potentially, the economy's weakening, the consumer's weakening. How do you start to position? If you're looking at your portfolio today, you've had a nice run, in terms of the markets. What do you recommend people do at this stage right now?
I think everyone should take a look to see how much growth is represented in their portfolio.
Mm-hmm.
Those handful of.
Where's your attribution? Yeah,
exactly. So I think there's a lot more risk in portfolios right now than people realize, not just from a stock allocation perspective, but from a concentration perspective. And growth, I would argue, is probably overowned.
Yeah,
we're due for a rotation to some parts of value, and I think there's different ways to get commodity exposure. Through commodity equity, there's different ways to play that. But I think commodities overall are about the smallest representation in portfolios.
Very minor.
And if you believe in those factors that will support a higher inflationary forecast, then it makes sense to have something that acts like a commodity or more economically sensitive than just large cap growth. So a broadening of the diversification is likely to be more impactful.
Well, I agree, and I think, like you said, it's never a bad thing to take profits, and something that people should always remember, and especially when you get to pretty nosebleed levels in the market and things are starting to look like they're softening. Not a bad thing to do. And you're right, commodities has been under-owned for quite some time, so I like owning things that are undervalued, at least at a good time where you might see a bullish case on them.
Remember that old phrase, buy low, sell high?
That's yeah. I don't know why everybody seems to be forgetting that. They're buying high and selling low. But you know what? On that note, Kevin, thanks for joining. I think it's great advice. And we got plenty to come here for the rest of the year, and we'll be seeing you soon.